Assalamu alaikum students. How are you? I hope you all are doing good and enjoying the e-learning classes and learning a lot new things. So once again, welcome back to my economics class. Let's start our today's video. So today we are going to start a new chapter, chapter number 4, that is cost and revenue analysis. So now let's have a look on the topics which we are going to cover in this video. So here are the topics. The first one is cost analysis and its concepts. The second one is short and long run cost curves. The third one is revenue analysis and its concepts. The fourth one is relationship between marginal revenue and average revenue. So cost analysis. We are starting with the video with the term cost analysis. So cost refer to the total expenses incurred in the production of a commodity. Whatever the amount is spent in the production is known as cost. So cost analysis refers to the study of behavior of cost in relation to one or more production criteria, like namely size of the output, scale of the production, prices of the factor which is used in the production, and other economic variables. So basically in this term we analyze all the things, all different criteria which is used in the production. We minutely study all this behavior which impact on the production, that is known as cost analysis. Detailed study of all the behavior. The next term is cost function. Cost function is the relationship between output and cost. It just tells us about how much cost is incurred to produce how much output. So basically we calculate the relationship between these two. That relationship is known as cost function. So here are the list of cost concepts. So the first one is money cost, real cost, explicit cost, implicit cost, economic cost, social cost, opportunity cost, sunk cost, fixed cost, and variable cost. They have a minute difference between these all. You just have to carefully listen and then you have to understand these concepts. So here are some cost which is very much similar, but there is a frequent difference between these all cost. So starting with the first term, that is money cost. Money cost is nothing but the amount which is spent on the production is known as money cost. And what is real cost? Real cost is the payment which is made to the factor owners. That is, we just have many a time discuss about this term, that is when we are using the land, we have to give the rent. When we are using the capital, we will have to pay the interest. And when we are using the labor, we have to pay the wages. And when we are using the owner wise his information, then we have to give the profit to the owner. So this is all talking about the business. So basically real cost refer to the payment actually made to the compensate the effort and sacrifices of all the factor owners for the services in production. That is known as real cost. The next cost is explicit cost. It is also known as actual cost. It actually incurred by the firm for making all the physical payment and contractual obligations. So basically explicit cost is the cost which is incurred on the things which are used in the production, and we can calculate it very clearly because everything regarding this cost is available. The data is available regarding this, how much we are paying to the labor, how much we are paying for the material purchased, building purchase, technological changes which are occur in the business, how much we spend on these all things. We have some data with us to calculate for account. On the other hand, we have another cost, that is implicit cost. So when the owner uses his own building for the business purposes, if he is using his own building for the business purposes, then he have not to pay any rent to himself, but still that is the cost, and that cost is known as implicit cost. But that cost do not have any accurate amount of data which we have in explicit cost. Just see what is written here. Implicit cost represent a company's opportunity cost of utilizing resources at it already owns. The company already owns these resources. So implicit cost are resources contributed by the owner of the company or paid out of pocket costs such as a building used for business operation rather than generating rental profit. So example is very similar here. A business owner may take a pay cut to remain profitable. This loss of earning for the owner is implicit cost for business. Suppose a business owner is not getting any salary. He is just cutting his salary so that he can show more profit in the business, but indirectly it is a loss of earning to the owner, and this is known as implicit cost. So the next cost is economic cost. So in economics we have to calculate everything, and we have to calculate even that rent which is not paid because we are using the building of the owner, but still we have to assume some amount and we have to add with the explicit cost to calculate the economics cost. So it refers to all the payments made to the resources owned. Owned means which we have already with us, with the purchased or hired by the firm in order to ensure their regular supply to the process of production. Whatever is incurred in the business, that is explicit cost, we have to add up with the implicit cost to calculate the economic cost. So the next cost is social cost. So social cost it's not in the amount of money. Actually, it is the society which is bearing the loss of something due to the production in the production houses. So basically, the social cost is the cost related to the working of the firm, but is not explicitly borne by the firm. Instead, it is the cost to the society due to the production of commodity. So you will better understand with the example, that is large business firm cause air pollution. No doubt that large business firms are producing so much goods and services for us, but indirectly they are creating the air pollution in the environment, water pollution in the environment. Who is facing this problem? We. So that cost is known as that sacrifice cost. We are sacrificing our health with the production occurring in the production houses. So that is known as social cost, and it is not expressed in the money terms. So the next cost is opportunity cost. So opportunity cost is the value of something when a particular course of action is chosen. Simply put, the opportunity cost is what you must forego in order to get something. Here is given example, but I will give you another, practical example. Suppose if a person got a job opportunity from two companies. One company is offering him 10,000 and the another company is offering him 20,000. Obviously, what would be your answer? He will go with the company who is offering him 20,000. But in economics, we study the opportunity cost. For that sake, for that purpose, the person forego the opportunity of the company whom he was given the 10,000 offer. That 10,000 will be opportunity cost. To get the 20,000 opportunity, he sacrifices the opportunity given by company A, which is offering him 10,000 salary. So I hope you understand with this example. So here is also a given example. So that is, for a farmer choosing to plant corn, the opportunity cost would be another crop he may have planted like wheat. So in this, they are taking the example of farmer. Suppose the farmer have a land and he is going to plant corn in that. But he can also plant wheat there, but he is sacrificing wheat to produce corn. So that cost is known as opportunity cost. Sunk cost. It is very important cost. You have to understand, it is frequently asked in the exams also. So a sunk cost is irretrievable, irreturnable cost. Once spent, the sunk cost cannot be recovered from the firm leaves the industry. whatever the amount is spent by the industry, that will never be recovered by the industry. The example will make you clear the advertising expenditure. If a company advertises a new product, that money is gone and cannot be retrieved. So I will take example like many companies are hiring actor, cricketers for promoting their product. You know what? That cricketer actors cost so much amount to act in their advertisement. The amount which is spent by the producer is retrievable. It is irreversible. It is irreturnable. So that cost is known as sunk cost. So the next cost is fixed cost. Fixed cost is the cost which is used to purchase fixed assets basically. So variable cost means our cost which change. So basically the basic difference between these two is the fixed cost never changes with the change in the output. How much you are producing day by day, it will not affect on the fixed cost because in the very beginning you just have spent so much of money in purchasing the fixed asset. So in the short run time period, you will not need no need to spend more money on the production for the sake of fixed assets. So variable cost means the cost which is incurred to get the raw material, to pay the employee, which is directly linked with the output. If there is change in the output, the variable cost will also change accordingly. So our next topic is short run cost curves. So what do you mean by short run? I think in the previous video also we have discussed about this. So basically short run means a time period in which we have two types of assets, that is fixed asset and variable asset. So we can change these assets frequently in a short time period. Fixed assets are machinery, building, plant. We can't change it in a small time period, in a short time period. So that's why in a short time period, we have two types of asset, that is fixed asset and variable asset. In the same way, we have different cost in the short time period. Are you understanding? So basically in economics, in short time period, we have to deal with two types of things, that is fixed and variable. Fixed, I will discuss in the coming concepts. So here are the short run cost curves. I hope you have understand the word short run. Now we're gonna see what are the points which covered under the short run cost curves. The first one is total fixed cost. The second one is total variable cost. Third one is total cost. Then there is average fixed cost, average variable cost, average cost, and marginal cost. So let's start with the first point, that is total fixed cost. As with the name itself, you can understand the cost is fixed no matter what is the output. So you can see here clearly, let me use the laser here. You can see clearly when you start a business, you have to invest on the fixed assets in the company, in the business. You have to purchase the building, you have to go for the land, and you have to go for the machinery, and you have to spend a lot of money on that purposes. And you can't change that frequently. I just told you. So, but we have to calculate that cost while calculating the cost of production. So that's why total fixed cost mean there is no change in the cost with the change in the output. Whether the output is 0, whether the output is 1, whether the output is 2, the number can change in output, but the cost will remain same at every level of output. So there is no relationship between output and total fixed cost. The total fixed cost remain constant in the short run time period. So that's why the curve is parallel to the x-axis, because there is no change in the fixed cost. If there is changing the output, but still there is no change in the fixed cost. You can see when the output is 0, the total fixed cost is still 1000. We are not producing anything, but we have started the business, then still we have to incur the cost of fixed assets, that is 1000. And when the output is increasing, the fixed cost remain constant. This is the very basic difference between total fixed cost and total variable cost. Have a look on the total variable cost now. So the C, total variable cost. Variable means changeable. This cost means that cost which change with the change in the output. And I can give you the example of this, like purchasing the raw material, giving the wages to the labor. Okay, if we are producing nothing, then there is no need to purchase the raw material. Suppose if the output is zero, there is no need to spend any money on that. There is no need to spend the money on the labors. Are you understanding? So that's why if you want to increase the output, you have to increase the variable cost. Variable cost means changeable cost. The cost which changes according to the change in the output. So it moves with the change in the output. So they have a relation between them. So here you can see when we have produced 1 unit of output, the total variable cost is 200. So accordingly, it is moving higher with the change in the output. So here is total cost. Third term is total cost curve. So just now we have understood 2 points. That is total fixed cost, the cost which do not change with the change in the output. Then we study about the variable cost which change with the change in the output. So, and now collectively we are talking about the total cost, which is the add up of these two costs, which tells you the total cost, what is the total cost incurred in the production. So just see, when there is zero output in the production, still we have to bear the fixed cost, that is 1000, but the variable cost is zero here, but still the total cost will be 1000. In the same way, when the output is increasing, the fixed cost will remain constant, the variable cost will move accordingly, and the total cost will be the add up of total fixed cost and total variable cost. So here you can have a look on this. Total fixed cost is starting from 1000 point, but the total variable cost curve is starting from zero, because when the output is zero, the total variable cost is also zero. That's why the variable cost curve starts from the point of zero, but fixed cost curve starts from the point of 1000. And we are talking about the total cost curve, and obviously it is the add up of total fixed cost and variable cost. Then the total cost curve will start from 1000. So this is the add up of total fixed cost and variable cost moving upward. So the next term is average fixed cost. What is average? Per head cost. So basically the formula to calculate average fixed cost is total fixed cost divided by the output unit. So first one is we produce nothing, but still we are dealing with the 1000 fixed cost. And what is the formula? Total fixed cost divided by the output. So here is the fixed cost, that is 1000, but output is 0. So that's why the answer is infinity. We can't go for any amount. When the output is 1, the fixed cost remains same. As I told you, it has no link with the output. It will remain constant. So 1000 divided by 1, the average fixed cost is 1000. So accordingly, you can calculate the average fixed cost. So per head cost, how much we are bearing, that is the average fixed cost, and it will start decreasing with the increase in the output. So that's why the curve is downward sloping. With the speed of increase in the output, there is a decrease in the fixed cost of average. Now here is average variable cost. Just now we have studied about the average fixed cost. Now we are going to deal with variable. So variable cost, I told you that it has link with the output. If the output is increasing, the variable cost will increase accordingly. And if we are producing nothing, the variable cost will be nothing. And if we are starting the quantity producing, if we produce 1 unit of the quantity, it will cost us 200. And we can calculate per head cost of variable, that is 200 divided by 1. Accordingly, we can calculate all the terms. all the amounts here. So it will decrease first, like let's see, 200, 150, 133, but it will start increasing after a while point, because we have discussed about the economies and diseconomies in the previous video. I'm not gonna explain that again. You just have to remember, in the beginning we face so many advantages that we have much capacity to produce something, but with the time there is a decrease, there is a disadvantage with which the business have to face. That's why the cost start increasing, per head cost. That's why it is U-shaped. You can see here. In the beginning, it start decreasing the cost. Are you understanding? If the cost is decreasing, it's a good thing for the company. And if it is increasing, it's not a that much, effective thing for the company. So that's why it is a U-shaped curve. That is average variable cost. So this is very important term, that is average cost. How you calculate total cost? By adding up the total fixed cost and total variable cost. So in the same way you can do as it is also, like let's see, average cost is the average total cost. Okay, so you can add up average fixed cost plus average variable cost, or another thing you can also do, that is total cost divided by quantity. Just let me explain you once. Per head cost, we are going to calculate per head cost how much we are bearing to produce 1 unit of quantity. So you understood now that the total cost contains the total fixed cost and total variable cost. And if you want to calculate the average cost, you can calculate by total cost divided by quantity. That is 12,200 divided by 1, the answer will be 1,200. In the same way, we have another way to calculate this, that is average fixed cost plus average variable cost. You can go for average total cost. So there is no difference. It's up to you what formula you want to apply. So here is the graph of average total cost. It is also U-shaped. In the beginning, it start decreasing the cost, but after a while, it start going up. So the next term is marginal cost. Till now you have completed the chapters and you should understand, being an economic student, what is the meaning of marginal. Marginal means additional. Okay, so in the beginning we produce nothing, but still we are facing the cost of fixed cost, that is 1000. The marginal cost is nothing. But to produce one more unit of the output, we have to incur some cost. The additional cost incurred in producing the additional unit is known as marginal cost, and you can calculate by this. 1200 minus 1000, that is 200. 200 additional amount is used to produce one more unit of quantity. So in the same way, so to produce the second unit of the output, you have incurred the total cost 13,300. It also contains the cost of first output also. So to calculate the marginal cost, the additional cost, how much incurred to produce one more unit of the output, you can simply subtract from 1300 minus 1200. So it is also U-shaped. So let me clear you one thing. While explaining these terms in the exam, if they ask you in the exam, you can't just explain by the statement. You have to give the table and with the diagram. In economics, the diagram is must for draw. You have to draw and you have to explain the diagram with the schedule here. So the next concept is the relationship between average cost and marginal cost. So before going further, I would like to explain you that the both costs are calculated from the total cost. As you know that average cost is equal to the total cost over quantity. And in the same way, marginal cost is the difference between two total cost, which is, the cost which is incurred in the production of additional product. So basically, what you have to remember in writing in the exam, if they ask you this question, you just have to remember always average cost and marginal cost. Marginal cost always lies below average cost. So basically, why I'm saying the relationship between average cost and marginal cost, because they are both calculated from the total cost. So obviously they have some relationship between them. So the first, we are here studying the concluded points. So just remember these points. The first one is when AC is falling, MC lies below AC. So here AC is falling, MC is also falling, but below it. And when the AC become constant, constant means there is no change. When AC is constant, the marginal cost is exactly equal to the average cost. You can see here, it's same. So when AC start increasing, the average cost start increasing. At the time of increasing, marginal cost is above the AC. But when it is decreasing, the marginal cost is below AC. So MC curve always cut AC at its minimum point from below. Whenever MC cut AC, it always cut from the below. So these are the some points, only 4 points you have to remember, and it is very important from the point of view of exam. So just carefully learn these points. So the next concept is long run cost curve basically. So in the short run cost, what you have understand that in short run time period or in short time period, we have to incur two types of cost, that is fixed cost and variable cost, because in short time period we can't change the fixed asset. But now we are talking about the long time period. In long time period you can change the fixed asset as well. So that's why in long run, in long time period, there is no fixed cost. All costs are categorized as variable cost. So the existing size of the firm can be increased in the case of long run because we can expand it because we have more time with us now. So what is long average cost? It is nothing but the summation, but the add up of short run average cost. So basically we are drawing this, you know that average cost is U-shaped. So short run average cost 1, short run average cost 2. By adding it all, we can get the long run average cost. It is also U-shaped here. So the next concept is revenue analysis. So let's see what is written here. The revenue refers to the income obtained by a firm through sale of goods at different prices. So there is a difference between revenue and profit. I want to make it clear to you. Revenue is the total amount received by the producer by selling the products in the market at different prices. So in other words, revenue means the earning earned by the producer by selling the goods and services. So here is the example. Just see, the price of one pen is rupees 5 and the producer sold 100 units of pen. So how to calculate revenue? By multiplying the how much you sold the output with the price in the market. That is, the output you sold is 100 and the price of the pen is 5. So total revenue is, the revenue is 500. So basically the how much the producer earned by selling the output in the market. Here I'm not talking about the profit. We are just talking about the amount collected by the producer by selling the goods in the market. So here are the concepts of revenue. So basically we have to study these concepts. It is very much similar with the cost. Like we are studying the points total revenue, average revenue and marginal revenue. So with these total, average, marginal, you are very much familiar with these terms. You just have to mold the term to understand it. So let's have a look on the total revenue. So total revenue is as much very much similar with the revenue. So total revenue in economics refers to the total receipt from sale of a given quantity of goods or services. It is the total income. So it's very much similar with the revenue term. We are just talking about the total revenue, how much the producer earned in totality by selling the goods in the market. So it is also calculated by the multiplying the quantity sold with the price prevailing in the market. So here is the example. Just have a look on this of total revenue. So when you sold one quantity of unit, let's suppose one pen costing of 10 rupees, which is the price of a pen is 10. So how much the seller earned? Rupees 10. So in the same way, when he sold 5 unit of the pen, the price is 10. So how much he earned? 50. So this is the total revenue, and it is always upward sloping, going upward by selling the quantities more. More quantities sold, more revenue will be there. So the next term is average revenue. So average means per head revenue. So as the name suggests, is the revenue that a firm earn per unit of output sold. Per unit of output sold, how much it gives the benefit to the seller is known as average revenue. Therefore, you can get the average revenue when you divide the total revenue with total units sold. So it is very much similar with the average cost. Average cost is calculated as dividing total cost with the quantity produced in the company. So in the same way, average revenue is calculated by total revenue, how much the seller earned by selling the goods in the market divided by the how much unit he sold. So it is nothing but the price of the good. So here are the description of the formula. So the next term is marginal revenue. What is marginal? Marginal means additional. How much additional money is earned by the seller by selling one additional unit of good in the market? So in other words, it is the additional revenue that a firm receives when an additional unit is sold. So the formula is MR is equal to TRN minus TRN minus 1. What is it? Suppose by selling one unit, you get total revenue of 10. And by selling another unit, you got total revenue of 20. So if I want to calculate the marginal revenue, what I will do, I will subtract the 20 minus 10, that is the term just now I sold, that is 2, and I will subtract it from the earlier sold unit, that is 1. So it is TRN minus TRN n minus 1, or you can also calculate by MR is equal to delta TR. Delta means change in the total revenue divided by the change in the quantity. So but I gave you the example 20 minus 10, that is 10. How much additional sold? 1. So 10 divided by 1, the answer will be 1. 10. So now we are going to study the relationship between average revenue curve and marginal revenue curve when the average revenue and marginal revenue is constant, means the price remain constant. So just see, when 1 unit of quantity is sold, the price of the quantity is 5. The total revenue is 5, the average revenue is 5, and marginal revenue is 5, same. But when we sold another unit of the output, the price remains same. The total revenue will be 10. Why? Because we just know that how to calculate total revenue by multiplying the output sold with the price, that is 2 multiply 5, that is 10. And average revenue, how we calculate average revenue? By dividing the total revenue with the output sold, that is 10 divided by 2, that is 5. And how we calculate marginal revenue? The difference between these two, that is 10 minus 5, 15 minus 10, 20 minus 15, 25 minus 20, 30 minus 25. So here we can clearly see that average revenue is same as price, so it is same. In the same way, marginal revenue is also same. It is constant at every point because the price is constant. The reason why these two are same, because the price is constant. So the curve of average revenue and marginal revenue will be parallel to the x-axis because there is no change in the cost with the change in the output sold. So in the previous slide, you just have understood that when the price is constant, the average revenue curve and marginal revenue curve remain parallel to x-axis, remain constant. But what happened when the price is decreasing? We just have to see now. So what I told you that the price is nothing but the average revenue. So average revenue is 10 or price is 10, the total revenue is 10. And when the output sold is 2, the price decreases to 9. The total revenue also changes to 18. And what is marginal revenue? Marginal revenue is the difference between these two, that is 18 minus 10. So again, when the third unit of output is sold, the price goes down, that is 8. The total revenue is increasing, but not with the same rate. So 3 multiply 8, that is 24. So how we calculate marginal revenue? By subtracting these two. That is 24 minus 18, that is 6. So you can see with the example that total revenue is no doubt increasing at certain point, till certain point. But the marginal revenue is decreasing. Why it is decreasing? Because the price is decreasing. It is not giving that much amount of revenue because of the decrease in the price. At some time, at some point, the marginal revenue is 0 and also it is going down. One thing you have to remember is that total revenue will never goes to negative, because it will be in positive but it will never go to negative. So the marginal revenue is going negative. So here you can see the average revenue is decreasing, the marginal revenue is also decreasing, and but it also goes to negative also. So that's all. Now it's time for you people to note down the assignment question. So the first one is, what do you mean by cost analysis and cost function? The second one is, explain the concept of cost in detail. The third one is, explain the short cost curves in detail. The fourth one is, what do you mean by long run cost? The fifth one is, what is revenue analysis and explain its concept. The sixth one is, explain the relationship between average revenue and marginal revenue in case of constant price only. No need to explain the decreasing price concept. You have to just explain of the constant price case, the relationship between average revenue and marginal revenue. So that's all from my side. Thank you students. Assalamu alaikum and take care.